So after what looked like a really good rally on Thursday that might have the opportunity to really get things going again back to the upside, we reversed that and then some here today. And so we're going to take a look at just kind of why we had the kind of day we did yesterday when we probably shouldn't have. And then how things corrected today and what the significance that today's move has from a technical perspective, some of the patterns that formed, some of the breakouts that occurred, and why it might be more significant towards like what we might expect this upcoming week or a few weeks actually as we potentially start a new move in one direction or the other. So we're going to break that down from a technical. I'm going to kind of show you what I expect and why and what's driving a lot of this action. And then we'll take a look at our trade idea of the day, a stock that kind of fits what the market's doing, especially the NASDAQ, the kind of pattern we're seeing there, and the type of potential that we could get on trades like this if the market does make the move we expect. And we'll talk about how to set up the trade for those expectations. So let's go ahead and get started. Today is Friday, September the 15th, 2023. This is the Market Outlook from MarketScholars.com. My name is David Settle. Before we get going too far, I invite you to subscribe to our YouTube channel with this icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website on MarketScholars.com for free. Follow me on Twitter for more content between the videos, and join our Market Outlook Facebook group that we've created. All right, if you're watching us here on our blog, check out some of these other things over here on the right, including our Market Outlook live video I do at 3:30 Eastern Time on Monday, Wednesday, and Fridays. We take a look at old trades, whether we should stay in them or not, put on the new trade before the market closes. Come down to the bottom, click this heart. It opens up this tab. Hit that like button. Same thing here. Click that thumbs up icon. Click that like button there too. Again, that helps us get our content out to all of our followers. It's a big deal for us. That's why we always ask. Our goal is to get to 100, so we're getting close on that. So again, thank you very much for those who like these day in and day out, and those who don't, you can like right now. Click with just one or two really easy clicks. All right, let's start off taking a look at the S&P 500 with the market forecast indicator. As you can see, we finished on a pretty significant down day, one of your bigger down days that we've had for a while. I mean, you have to go back over here to August 24th as you look at it from this perspective. It was more than 1%. In fact, we had to go back further than August 24th. That was the last time we had a bigger than 1% decline. We had to go back to April the 25th that we've had as big of a down day as what we had here on Friday. And that April 25th day, you can see, started with a gap not as big as what we had. The last time we had a gap this big was back here on June 6th, and we ended up rallying most of that day. So basically one of the more bearish days we've had, and again, not fall off the cliff bearish, but one of your bigger down days we've had in a while. It kept the momentum line, which got up nearly to extreme levels there, ended up down nearly or slightly into extreme levels to the downside, just below that 5th percentile. It brought the near-term line down, so the near-term line had peaked its toe in the bullish territory yesterday, right there. It's back down below its intermediate line again. The intermediate line remains below market sentiment, though it's still rising. So you got the dark green shading, even with the fact that we are back below a falling moving average, which is why it's turned red. So dark green shading and a red line, not very common, but that's the combination we happen to have right now. Let's take a look at some of the other indexes. Looking at the NASDAQ, falling below its moving average, or falling to its moving average, just barely above it. Intermediate line still above its market sentiment line, though the near-term line staying below the intermediate line. So unlikely that it would be able to keep going up very much longer. You look at some of these. Let's go back to the SPX here really quick and pull up these Fibonacci lines that we've got drawn. Again, the last intermediate rally, we're still in retracement mode, though we're still actually above the 23% retracement line. So again, it puts into context just how bearish we are, or pretty much not bearish we are right now. Despite how big of a down day that was, We'll see if it turns into anything more over the course of this following week, but you're still at very strong levels. You still got support at 4,300, and then of course another layer right around there based off different multiple Fibonacci levels around 4,200. Obviously some volume levels associated with that as well. If you take a look at the Dow Jones Industrial Average, it got that bear tag on Thursday and it failed, right? So instead of following through with that with more of a sustained rally, we got right back down below. Intermediate line still rising, so it's still light green shading, but that momentum line dropping back down pretty quickly there. And then looking at the Russell 2000, you can see it's still dark pink shading the red line. So it's actually still, we failed on this bear tag about a week or so ago, and it's still continuing lower after getting a cluster here on Monday. We finished the week with a down day. The near-term line still rising, but barely into bullish territory. And the intermediate line is actually still in the reversal zone. So we are still, that's how strongly bearish we are. The intermediate line is actually still below 20 and staying there for right now. Despite a pretty decent day on Thursday that had its momentum line jump into the upper reversal zone. Let's take a look at the weekly chart for this, for the market forecast. And you can see its intermediate line is falling below the 80th percentile. Its near-term line still below and turned back down, so it might be a bearish near-term peak here, as the near-term line did not get above the 80th percentile like it did last time we had a near-term rally. So, and you're already back down almost into bearish territory again. So this would be a pretty bearish near-term peak if that's on a weekly basis, at least, if that's what ends up. As you can see, we got pretty strongly above that 30-week moving average there at about 10%, and we've been declining ever since and dropping further. And you can see some of especially on the Russell 2000, we're actually flirting with getting below that. We're still a third of a percent above it, but the intermediate line is definitely falling. The near-term line did not get above it and turned back down into the reversal zone. So we are definitely in kind of bearish mode right now on the Russell 2000. It's forming another bearish peak on the intermediate line that, again, was not really able to get into the reversal zone and stay there, right? Which is what happens when you get on these bullish runs. And again, it's more bearish when you get these kind of peaks and we don't follow through with a good long rally. It's been a pretty sideways trend for the Russell 2000 for pretty much for over a year now, just fluctuating here between about 2,000 on the upside and roughly 1,700 on the downside. Let's take a look at the other weekly chart that we like to look at here. So we'll come over to the 10-week crossover chart. As you can see, it's we talked about last week's lower high point. We ended up getting a slightly lower close this week. So the first time we got a slightly lower close, somewhat of a transition there. You can see the actual candle was not quite too bearish. So we might end up with another transition candle or two. We don't quite have the bearish candle that are really reversing to the downside. The Hakinyashi differential down here did fall below its moving average and never did get very strongly bullish. The PPO is still falling, and we don't have a red arrow, so at least we're still above the 10-week moving average. Of course, that's not the case for the Russell. The Russell did get that red arrow last week. It got a bearish candle this week, and we actually closed again for the second time in the past 4 weeks. We have a Hakinyashi close below the 40-week exponential. So basically the 200-day, that PPO falling, not very big of a gap. So looking like the Russell 2000 is making a run at another death cross environment that you had briefly here following the financial issues with the regional banks, and then of course during the correction. And again, it's not common to get these death cross environments. You can see you got some there in fourth quarter 2018, and then with COVID, and then the 15-16 correction, 2011 correction. The bear market over here, it started with that correction at the end of 2007. So, they typically are corrections when you get these death cross environments, and it appears that we may be headed towards another one now, considering the red arrow and, like I said, the close the Hakinyashi close below the 40-week. Now, that doesn't guarantee anything, but you start getting concerns about the beginning stages of another correction when you do cross below and your PPO falls, and this, to a low number, in this case really only 1%, with a negative Hakinyashi differential that's it's staying negative and falling back below its moving average. So it appears the Russell 2000 may be flirting with the beginning stages of another correction. Of course, it started a lot earlier over here than so over here was that week of Thanksgiving. It started its weakness a lot earlier in the last correction than the S&P 500 did. The S&P 500 actually got new highs there at the beginning of 2022 before it started to fall. That wasn't the case with the Russell, and we might be seeing something similar occurring right now. Let's take a look at some of these other charts, of course, from a 3 green arrow standpoint. You notice we do have 3 red arrows on the S&P 500 again. We do not quite on the Qs, though close. We don't have the 3 red arrows on the diamonds, and we do have 3 red arrows again on the S&P. So again, are we going to get 3 red arrows and continue? This is an important week, because it'd be very nice if you got 3 red arrows for only one day and you bounce back up. The difference though here is that that 3 red arrows occurred with the moving average rising. This 3 red arrows is occurring with the moving average falling. So a little different scenario, kind of more of a instead of it's kind of more of a bounce trade like we've gotten on these last. With the Dow only had one day of 3 green arrows, we've already reversed. So in other words, that bear tag failing on the market forecast chart. Same thing happening on the Russell 2000, as I mentioned more than a week ago. Now, looking at the 2-line version of this chart on the S&P 500, as significant as a close that was, because Thursday was so good. We closed above all the moving averages, closed above that Fibonacci retracement. But then boom, closing below the 8, 17, 30, and 50 yesterday by quite a big margin, with the MACD itself here, as you can see, below its moving average, close to being below zero. Stochastics below its moving average, close to coming, well, it actually is out of bearish territory. Strong volume and a big range, bigger than average range today, not including the gap, right? The gap, we closed at 450.36. The high at 447, so about another 3 points added to that. So you're looking at about 7.5 points with an ATR of only 4. So big range, big volume suggests there was something significant to that Friday move. Looking at some of the other oscillators, you can see that negative indicator did cross back above the positive, though they're still both right around that 25 level. Let's take a look at the RSI and the CCI, because that's kind of a telling indicator. You can see we're back below the midpoints of their charts, though not into bearish territory yet. We never did really get out of the bearish territory that we've been in. So this actually needs to go all the way out to today, because we never did. Even though we crossed above 50, we never crossed above 60. So we're still in bearish territory there. And we're still kind of in this bullish long-term run here, because we haven't crossed below. On the weekly chart the minus 100 level. So we may need to see more weakness here. Once we get below minus 100, that's when the correction really starts, as you can see with all these other corrections where we did drop below minus 100 on the CCI. So we're kind of flirting with zero, which you typically do during pullbacks. Getting below zero and then jumping back up above on the daily, jumping back above the 100 level, kind of nullifies that. So that happens. You drop below minus 100 on these pullbacks. That happens. In this case, we never did get a pullback here. We just converged for quite a while. But during these other pullbacks, you drop below minus 100, and we'll see if that ends up happening here, as we are about halfway there based off of Friday's move. Looking at the Ichimoku cloud, of course, you have a very weak bearish trend going because you're above 50, you're below minus 1. You are in the cloud, though you're still kind of on the blue line, not really below it by too far. And then you can see your red, the rate of change is slightly negative too. You never did get that bullish crossover on the cloud, so we're still bearish there. And again, by the time we get to the cloud, we want to be above it, not below it. So really important the next few weeks coming out of expiration to see how we behave here. Looking at the Bollinger Bands and the Keltner channel, so right down here, you can see again we're in the lower half of the bandwidth, but not in the lowest quartile. So not the bands are still outside of the Keltner channels, as we are now with some negative, at least less positive momentum. We'll see if that transitions as if we get down into the lowest quartile, and if we flirt with getting back below these levels, to see whether or not we are going to start, like I said, this new or continue this intermediate trend to the downside and potentially start a correction, right, with a pullback and a failed pullback bounce and then a correction there. Let's look at the volatility, or excuse me, today's intraday range. Again, we've been kind of watching this one touch on the Arun indicator, as bearish as it normally is, how rare it is and how bearish it is when we get them. We are now below 70 easily, and we are to 0 on the negative indicator, which means the low point's over here. That negative indicator is going to jump up a little bit because the low is going to move to this spot here. But the 4-week high point keeps moving over here, and we've got what looks like a runaway gap, right? We had a pretty significant gap. We had a pretty significant move to the downside. So this actually looks like the beginning stages of a new intermediate run where we do get that intermediate line to move back down into bearish territory. That's the type of gap that would start that. So you would expect, as I mentioned earlier in the week, that more likely we're going to cross through this lower of this last week's range. The week before's range, the brown lines, more likely we would cross below the lower one than the upper one. Even as we on Thursday got really close to it, still that likelihood was increased that we'd go below this one, and you can see there's not very much volume down there if you did. So we're susceptible to more of a move to the downside if we end up breaking this really short intraday kind of support level. Let's take a look now at we talked about the range, and the both the range and the volume is very strong for expiration, right? It was an expiration Friday. The VIX rallied almost up to 14, but again did not get above the 90th percentile, so we're not very strong there. And the VVIX didn't rally very much, so it wasn't that big of a move on volatility. That it's actually still below, if I remember correctly, it's still below its 8-day exponential moving average. I was sitting right on the 8-day. So as big of a move as that was, we're still pretty low. But it also goes to show just how much of a move we can get. And before we get our typical move on volatility that is corresponded to a pullback. So we never did get that here in August. As much as we thought, hey, August, we've had the pullback here, or we can now buy that dip. We never did get a lot of the characteristics of a typical pullback in August. And now with volatility during this expiration cycle dropping pretty sharply, we might start to get that now coming into the next expiration cycle, which is seasonally, traditionally, a strong time of year for volatility. We typically start to make a run on volatility post expiration in September towards that October expiration. All right, now let's take a look at what's driving this price action. What's really interesting was, and I tweeted this out, if you take a look at what happened on Thursday, we had this really crazy move because you had commodities that were bullish, you had yields that were bullish, so bond prices were down, and then you had the dollar that was bullish. That's a three-headed monster. It's usually pretty bearish for equities. You can see IWM was not bearish, however, and the Qs were still pretty strong, relatively speaking. Even international stocks did pretty well relative to U.S. equities, considering how strong the dollar was. And gold held up, again, considering how strong. It underperformed a lot of these asset classes, but still held up pretty well, considering that this was not a risk-on environment, generally speaking, for most of 2022. Well, that changed on Friday. You can see stocks really came back down, and gold ended up being relatively strong despite a dollar that was actually pretty flat. And bond yields were up a little bit, but not much. Commodities were down. So when you were to like go back, because I tweeted out, I was like, something's up. Like it was like an opposite George day for those that watched the Seinfeld episodes. There was an episode where George decided to do everything the opposite of what he would normally do, and that's kind of what the markets did. The stock markets had their own opposite George day. But when you look at how they put those 2 days together now, and you can see, okay, the dollar's strong, commodities strong, bond yields are up, and now stocks are down. Stocks are down, and gold is up. So it seems like it took a day took this extra day for things to kind of figure out, and you can see Q is really underperforming IWM. And that's what you would have expected in this environment. And you can see even international stocks, developed stocks still held up okay. Emerging markets also held up decently with small caps, though still lagging behind, like again the dollar, and lagging behind gold, and lagging behind commodities just in general. Real estate holding up okay too. That hasn't been the case. Usually it's been kind of following these other risk asset classes, though it's not been traditionally a risk asset class, has been here lately, more associated with that. So you can see kind of the moves that we're getting in some of these different asset classes, in particular bonds and the dollar, such big drivers, and bonds rallying up to 4.32% on Friday. After a pretty decent up day on Thursday too, after gapping down to the downside. Here's the dollar and its trend that it's going down a little bit on Friday, but still up pretty sharply on Thursday and holding a lot of those gains. And then finally, looking at commodity prices, in particular looking at gold or crude oil, and you can see crude oil is up above $90. I mean, it's just really going parabolic right now, and having a negative impact on risk appetite in general because of the inflationary forces that it can have. And one of the big relationships, and I tweeted this out too, that I've been following is XLU relative to the market. You can see when XLU makes a big run, in this case over the last 8 days, it's had quite the rally here coming off of the beginning of September, and you can see these last 8 sessions. This is the relative strength chart of XLU to the broader market, closing above after creating a pretty sizable gap. In fact, one of the bigger gaps between the 50 and 200-day moving averages that we've seen. So it's created that pretty sizable gap. And then made a run that you don't see during bull markets, right? Not that big of a move over 8 days, and so that's kind of telling, considering that this chart starts to fill in this gap to the 200-day moving average. The last time we had a sizable gap get filled in, that was during the correction of 2020, going into that election. The election of 2020 there, that pullback, excuse me, going into the election. And then we fell down further with the reopening trade. We were so bullish going into March, and then inflation started to hit, and stocks stayed bullish, though you can see we're converging on this ratio chart before the 2022 correction in the S&P, and this ratio took off. Well, here we are back down. We actually got lower than those early 2022 or late 2021 levels. So really bearish on this ratio. And then, as big of a breakout that we've seen, this is a bigger breakout than we've seen during any of these times that the markets are bullish. So it's not a bullish sign. We only see these kind of moves when the markets are bearish, right? The last time we saw something at least exceeding 5% was during the regional banking issues. So, and again, getting above the 50-day. Now, this time, versus there, the PPO here wasn't very small between these long-term charts. Now, the PPO is large, really large. So we are, again, set up for, and what's interesting too about Friday's big drop is usually those kind of moves, the skew actually drops. As skew measures fat tail risk, and when you get a big move to the downside, there's not as much fat tail risk anymore because we're bearish, right? Usually fat tail risk starts to build up as you move up. But that wasn't the case Friday. We had a big jump in the skew there. And we've had some relatively positive momentum, but a big jump in the skew up to almost 145, which is a high level with where the S&P is at. Again, on the down day, usually when you get these big spikes, especially coming off of one where we peaked, it's not necessarily the best sign, especially when the skew jumps so big on a big down, not even just a little down day, but a big down day. Again, like I said, not the best sign, and the breadth has not been very positive. You can see the breadth on the new highs back below. It's moving back below 200, minus 200, and back below its moving average. The number of stocks below there, 50-day, is back below its moving average at 171. Again, getting close to that 150 level. And then we talked about the Qs and their relationship with IWM. Again, after, another close above 2, but you see how bearish this is and getting back below the 8-day with a pretty sizable gap, the MACD turning down, but a pretty sizable gap there too in terms of just how bullish we are. If I give you some context of just how big that gap is between the 50 and 200-day moving averages. Again, it's higher than any other level except for post-COVID. And you can see, like I said, that MACD as high as it was now rolling over, CCI rolling over, RSI rolling over. And this correlation has been slightly negative and set to turn back up. And as I mentioned before, if and when it does, will both of these lines, will the ratio chart and the S&P both go up, or will they both go down? And considering how high it is and some of the divergent patterns and weakness patterns we're seeing, the probability is that they will both go down as this correlation returns back up to these higher positive levels. Let's take a look at the sector moves. So let's come down to the sector chart. And again, you look at, let's do this one. You look at Friday, right? We'll look at Friday first, or Thursday, excuse me, and see, as I mentioned, kind of an opposite George type day for the markets. Again, real estate and utilities were higher, along with materials. And again, communication services was good, but technology was lagging behind the market. Discretionary beat the market, but only by a little bit. And healthcare was, which has recently been strong, is down. That's not your typical. Energy actually did pretty well too. That's not your typical risk-on day. So you go out to now Friday's move, and you can see, okay, XLK, XLY, XLC both down as you would expect. Energy actually coming back down. Utilities and real estate outperforming. So if I were to look at the 2 days in conjunction with each other, now you can see, okay, on a market that's actually bearish, that's not surprising to see real estate and utilities doing so well, despite yields being up. Those are outperforming, and then you can see your two big losers down there, with communication services barely outpacing the S&P and lagging behind a lot of these other cyclical areas, safety trades too. So this is more typical. So again, it looks like Friday, as bearish as Friday was, it was because it was correcting what happened on Thursday, which was a little too much. We talked about in our class on Thursday that we have at Market Scholars that I wasn't necessarily believing that move on Thursday, and had some questions why, and we talked about that in our class. But again, Friday goes to show just how quickly the market can correct a pattern that probably shouldn't have been there, considering, like I said, the move higher in commodities and move higher in yields and move higher in the dollar should have produced a reaction in the market more like what we got on Friday than what we got on Thursday. And you put those two together, now this is more typical of the risk-off environment we had at the end of the week here. All right, that takes us to our trade idea of the day. I want to take a look at Adobe. Adobe looks very similar to a lot of these tech stocks that have just rallied up so much, especially going into that June expiration. And they have maintained a bullish trend, though more of a converging trend, like with far less momentum than what we had initially there during that parabolic peak. You can see getting a bull tag, which can be a bullish sign that we're bouncing back up, or it can be, especially after a long convergence like this, a sign, usually bearish. The bearish moves start with bull tags and intermediate line crossing below its long-term market sentiment, near-term line down and falling, and things looking more bearish for the stock. If you take a look at the close here, closing below the 17 and the 30-day, flirting with the 50, a little bit of a rally. This is coming after its earnings. Look how big that gap is between the 50 and the 200-day moving average. Just literally hardly any volume in this space because of how fast it moved. The MACD is bearish below its moving average, almost negative itself. The stochastics is coming out of bullish levels. Again, a lot of volume on this post-earnings day. So relatively bearish day. You can see, crossing most a weak exponential moving average with that MACD as strong as it has been and now moving lower below its moving average there, and the stochastics moving down too, still in bullish level. I mean, this shows how strongly bullish it has been. This is what this chart looks like. Again, you got a pretty significant transition candle there, and again that coincides with an actual bearish candle, kind of a evening star candlestick pattern there. You would expect, we don't have the red arrow yet, and again, like I said, the PPO is very high relative to how bullish we were going back before this correction started. It's a very, very strong move. The Hakinyashi differential is below its average, and it is moving lower. Let's take a look at some of these other oscillators for the stock. Again, we've been in this convergence mode for so long. The negative indicator now has jumped above 25. The positive is flirting with dropping below 20. You see how big the ADX got there during that, again, that parabolic peak. If you look at the RSI and the CCI RSI at its lowest level, it's been in for a few months. The CCI dropping below that minus 100, this time closer to minus 150. Again, the weekly has been so strong that we're just now starting to get, obviously less bullish and potentially flipping to the downside, especially with that gap in volume there. You see that here on the Bollinger Bands as well, getting into the lower half of the chart, closer to the lowest quartile, with the momentum really reversing to the downside. So I think there's some good opportunity to be bearish for the stock. They kind of set up, kind of a low probability but a high reward to risk ratio if it does play out. So low probability also, of course, suggests low risk. So I went to the options for November, so a little bit further out than normal. And then did a long put vertical spread going down to that 465, 470 level, getting about a 5-to-1 reward to risk ratio if it ultimately plays out. So being a little aggressive with the trade, knowing that, again, higher probability that it won't work out, but getting paid taking very little risk for it and getting paid very well if the stock ends up filling in that gap. Again, you can see its own runaway gap with the earnings announcement that it had. If you take a look at this chart here, again, one of the bigger down days, down 4%, but this one coming off of a more significant gap, down 3.6%. So it's been a while since we've had a big gap with a big down day, and would suggest that one of our more bearish days could lead to more weakness, especially considering, like I said, the lack of support the stock has before, and the big sizable gap in moving averages and volume that suggests that we could fill in that gap pretty easily here. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join us at marketscholars.com for free. Follow and like us on Twitter and Facebook as well. Have a great rest of your weekend, everybody, and we'll see you all on Monday.